G'day, Greg. I'm well, mate. How are you?
Very well. We're recording this on Monday morning. What is it? The 3rd of July, the 4th of July?
4th of July.
4th of July. There you go. We had a bit of an email and a text exchange over the weekend, and I thought it was an interesting chat, and I thought it'd be good to get you on the insider and get your thoughts on how things are playing out in one of the largest asset markets in the world. And I'm talking about bond markets and the effect, well, I guess the short-term effect that could have on equities, stock markets. So perhaps we could take a look to start at what's been going on in these major bond markets. And today we're going to look at the US 10-year Treasury yield and the Aussie 10-year Treasury yield.
Yeah, and I'll switch to the charts in a sec, but just to state the fact that it's not just in the US and Australia. This is sort of worldwide. We're seeing this big plunge into bonds in the last couple of weeks. So I think a few big players have decided, look, if I can go into US 10 years and Germans 10 years at 2% or 3.5% in the US, and everything else is looking pretty terrible. Obviously, there's some big money flowing into the bonds, and it's really, we're seeing a bit of a peak, short-term peak in the bonds, which could have quite a big effect on stocks going forward. So let's just start with this chart of the US 10 years. It's a long-term chart going back to 1980. So we're looking at the whole generation of rates falling. Now with this chart, just to make it clear for people, when the price is going down, this is actually a chart of yield. So when this is going down, the yield is going down. And the funny thing with the bonds is that when the yield's going down, the price of those bonds is going up. So this is a bit of a funny chart. I don't want people to be confused. So unlike a normal chart where price is going up, this is actually saying yield going up, which means the price is going down. So what that's saying is this sell-off we've had in the bonds is, the yield's going from near zero in those 10 years. And the yield went up to over 3% to 3.5%. And you'll see, just looking at this big picture one before I zoom in, that's pretty much the highest yield we've seen in those US 10 years for over a decade. So it was a major high that we just went through. And I was actually a bit worried going, gee, what's going to happen when it gets above that multi-decade high? Is the bond market going to really collapse? And I was a bit worried about it. And I think many other people were too. And what we've seen, I'll just zoom in now for you so you can see, and I'll go to a weekly chart. If we go in, you can see that these bonds in the last couple of weeks, just how dramatic the fall has been. It's gone from 3.5% above that level, and it's dropped now here on Monday morning, so at 2.89%. I mean, that's a 60 basis point drop just in the last couple of weeks. And the German bonds have gone from 2% to down to 1.2%. So that's an 80 basis point move, nearly a 50%, 40% drop in those yields from 2% to 1.2%. That's a big move. And let's move on to the Australian bonds as well. And you can see there on those 10-year bonds, they peaked above 4%, and they're now down at 3.5%. So that's gone from 4.25% to 3.5%. So that's a 75 basis point drop in yields just in the last couple of weeks. And so we're seeing stocks also catch a bit of a bid. I've got a weekly buy pivot in the stocks. So I'm feeling that everything's a bit oversold, and the path of least resistance for stocks is possibly up for the time being.
I was going to say before we get on to the stock discussion, Muzz, I think it's worth pointing out, the reasons behind the falling bond yield. So the big move up in bond yields and the big plunge in price. And if anyone's been invested in bonds in the past 12 months, they're going to have had a pretty rough time because it's responded to this inflation, right? So that the whole bond markets around the world have all moved higher in yield, responding to this inflation. But I think what you're seeing now is the fact that central banks around the world have become very serious about containing this inflation. And these longer term bond yields are saying, okay, we see what you're doing, and you're actually going to cause a slowdown around the world.
And a lot of leading indicators, a lot of economic data coming out now is rapidly dropping off. So people are sort of looking at that, all those leading indicators saying, wow, growth really is responding very rapidly.
Yep.
So this big fear and the bonds, if I'm looking at that 10-year bond chart, it's gone from 1% yield to 4.25% yield in, less than a year. That's a massive move. That's a huge move. So markets are really oversold. They've had a really panicked move at the end there as the inflation scare really, really hit, and we got those really bad figures out of the US. I think everything was just all over one side of the boat, and we're seeing a bit of a snapback now with those growth figures really coming off. People saying, well, if growth is coming off that fast, the peak in inflation's got to be around the corner. And the inflation figures are so high, up around 8% or something crazy. What's the chance that it really is going to just go up through to 10% and stay up at that sort of level? Pretty low if growth is plummeting.
Well, in saying that, and I've been writing about this quite a lot in the Insider over the past few months, in terms of inflation expectations or the longer term inflation break-even rate, it peaked in April at 3.02%, and the latest readings have it down at around about 2.35%. So even long-term inflation expectations have been coming down quite a lot. And I know we've got the headline inflation rate up around the 8% level, but the average expectation of inflation over a 10-year period, which sort of pulls out a lot of this short-term stuff that's been happening, and we know a lot of this stuff is supply chain led, supply side led. The market is saying that inflation expectations have peaked for long term as well, and they're starting to come back down. So I think one of the key things to consider is that we've got so much debt in the economy. Rising interest rates have a big effect, and as you pointed out, you're starting to see sharp indications of a sharp slowdown happening. And we've got the Reserve Bank meeting tomorrow in Australia. They're tipped to raise interest rates by 50 basis points, and all the talk is how many more 50 basis point rises will they have? I mean, people with large mortgages, variable rate mortgages, they're going to be seeing their discretionary budgets cut quite sharply over the next 3 to 6 months. So, I think we're going to see that slowdown happen in Australia as well, and the bond market is starting to price that in. So interesting. Just before we move on to the stocks and the effect that you think it'll have on the stocks, do you have an idea based on your sort of retracement theory where bond yields could actually get back down to in the next 3 to 6 months?
Well, I mean, look, let's just have a look at those 10 years, and this gives you a sense of how sharp this move has been recently. This is my long-term moving averages, right? So we've got the 10-month exponential moving average here, the red line, and the long-term one that I really follow is that 20-month. Now, look how far away yields are from that 20-month moving average. That's all the way down below 2%. So even just some sort of a mean reversion move, which is what you often see, like that 20-month is sort of the fulcrum around which the market oscillates. It always ends up revisiting that 20-month moving average. So just a very simplistic way of looking at this would be, and remember, this is yield going up, is market selling off. So it's very oversold. It's had a really sharp move. It's gone up to very strong technical level, that 3.25%, which was really in a downtrend, you're looking at those peaks in a downtrend as major levels. And it's gone and reached one of those peaks from this 40-year downtrend. So it's a very important level it just got to.
Yep.
So it's way oversold in the short term. It's reached a massive technical level. So, the usual thing you see is what we're seeing, a false break, the buying's coming in. So this could rally for months, head all the way back to that, meet that moving average. So you're talking, back down to 2.5%. If that does happen, that might just take the pressure off stocks being in this real panic state for the moment. But, I will add that if these bond yields fall, but then something happens, the inflation figures are really terrible or whatever, and it turns around and we see the yield busting up through that 3.5% level, that is for me very dangerous. So for now, I'd say the charts are saying they're overstretched. The yield should fall. The price should rally in those bonds. Just from a technical viewpoint, I should expect it to head back towards that 2.5% region. But I reckon it won't get much below there. But if we do see that sort of a balancing up period, I think stocks could end up catching a bit of a bid for a while, and we sort of see things settle down. But that doesn't say that it's all over yet, or that the low in the whole bear market's in. It's just saying that this panic sort of situation might just soften off a bit.
We've got room for a bear market rally. Well, let's have a look at the major stock markets now. I think we've got the S&P 500 and also the ASX 200. I guess the interesting thing, just while you bring those up, Muzz, is that the bond market is signaling weakening economic recovery, so it's selling off. Now you can look at that in two ways for equities, and I think this is what we're going to essentially discuss now. From a short-term perspective, it's bullish because the equities say, hey, inflation's coming down, bond yields are coming down, based on the sort of pricing, how you price equities, lower discount rates, that pushes up the value of equities. That's great. But on the other hand, you've got a slowing economy, which is going to affect the earnings growth of companies. So that's maybe a longer term reason to stay a little bit cautious. So, and I think that reflects in some of the charts you got in terms of the weekly signals versus the monthly signals. Yeah.
So let's start with the monthly chart, because I want to get that sense that the big picture is still bearish, right? It's no signs yet on the monthlies that this is over, but it has pulled back to some pretty major support, I guess. But I just want to point out the fact that the monthly trend has turned down on my moving averages. And what often happens, and this is, first time really since 2009, we had one very small period where it gave a false signal, but then it turned straight back up into uptrend. So, big picture, monthly trends turning down. You can see there, monthly sell pivot, that black diamond, that's just before everything really started collapsing. There's no signs of a monthly buy pivot. So big picture, it's all still saying, watch out. But what you often get is a mean reversion. Once the long-term trend turns down, and I'll show you this quickly, you often get a mean reversion back to those moving averages. And if the selling pressure is there, then that's when you got to worry about things really turning down. I just want to show you the example from the last few crashes, just to give you a sense of what I'm talking about. So you've got the long-term moving averages turned down. We've got the initial selling, then we've got the mean reversion back to test those moving averages. If the selling's there, watch out, right? And this is how it moves, right? Back to the moving averages. If the selling's there, watch out. Back to the moving averages, selling, watch out. And again, in 2008, that was the 2000 to 2002 sell-off. And here in 2008, long-term moving averages turned down. We've got the initial wave down into buying support, then rallies back to the moving averages. Is the selling pressure there? Yes, it is. Watch out. That's when you get the really big sell-off. So that's the phase that we're in at the moment. So I want to just make that point quickly. That big picture, it is sort of saying, well, we've had the long-term moving average change down. We're now in this phase where we could actually see a balancing up period. But I'm interested to know what happens back at those moving averages, because if it does turn down from there, that's when you're looking at pretty big move to the downside. So you'd be using the opportunity to take profits, I guess, or get out of things if you've been a bit scared lately. If we do see a nice big rally, you can probably make money on this rally, and I'm probably going to buy it if I see the right signals, which I sort of am seeing. But I'll be pretty quick. You'll be pretty nimble, I guess, is the idea. So let's shift to the bullish aspect. And what I'm seeing here is just the fact that we've got, and I guess the first point is when it's trending down, do you see it's trending down? The sell pivots are the ones that are most likely to work. I mean, that makes sense, right? You have that when the trend is down, market tries to rally, turns back down again, I get a sell pivot, then it keeps trending. So often when it's trending down, it's the sell pivots that work. And when it's trending up, you can see these green diamonds. It's the buy pivots that are more likely to work than the sell pivots.
Yep.
That just makes sense, right?
Yep.
So when you're going against the prevailing trend and trying to buy it, you've got to be aware of that fact that you're going against that prevailing strong trend. So the likelihood it's going to work is a bit less. But what I am seeing, it's very oversold. I've got a nice, sorry about that. I've got a nice weekly buy pivot there a couple of weeks ago. And last week saw the selling. What I like to see is buying pressure coming in around the buy zone of that buy pivot. And we're seeing that. And it's just a situation now where it's not going to take much. If it turns back up and does rally, you're going to see that mean reversion move. It really has sold off very hard for a long time. And I just think the path of least resistance at the moment is going to be up. We've had a lot of tax loss selling. I want to make that point that in Australia, small cap stocks have been selling off for a year and a half, right? They've already been terrible. And in this tax loss selling season, I mean, you had plenty of stocks where people were going, well, I'm just going to get the hell out of this. So it really has been a very serious tax loss selling season for us. So any signs of a rally, with those bonds rallying, if stocks now do respond to this weekly buy pivot and actually do turn up, I think a lot of those really beaten up small mid-cap stocks, you could see quite a good vicious bounce in them.
Yep.
And that's tradable. But that's not saying that long-term, those big picture charts aren't going to end up taking hold again, and we're not going to see another big wave down. If, as you say, lots of companies are coming out with profit warnings and that sort of thing. So I'm not calling a low in the bear market. I'm just saying that there are signs out there saying that we might see a bit of a short squeeze from here. So which is tradable.
As you can see on that chart, we really haven't had much of a short squeeze in this whole 2022 bear market. It's been mostly selling, and I think people who have been around for a couple of cycles understand that bear market rallies are pretty good at luring you back in and making you think that the worst is over before turning back down again, which is where the charts can come in really handy, because if the selling shows up at certain points, that the bear market's still intact.
Most people are sort of, like you said, in these bear market rallies, you can see this rally that we've got here. Most people, I can tell you, are actually buying it up the top here,
yep.
And then they get killed. What I'm trying to do is say, no, I'd rather be buying it early, because if it does turn down below that low, I know I'm wrong.
Yep.
So all I'm saying here is that the risk reward at the moment is all I've got to really do is risk that much. But if we do see a squeeze, it's going to go quite far to the upside. So there's a trade there. So what I'm talking about here is more short-term trading perspective than big picture. Let's plunge into the market again. So I want to make that point.
But as you said, that can help people out who are long-term investors, and they might want to lighten up. They might want to change their portfolio a little bit. But if you can do that during a positive rally phase in the market, it's much better to do so than a panic phase like last week. Are we able to have a quick squeeze at the ASX 200 before we finish up, mate? Any change there, or is it a similar situation to the S&P 500?
Well, it is interesting. I'll start with the weekly chart here, and what I want you first of all to note, the way prices move is of creating new lows and then having mean reversion events. So this is what gets everyone, right? Everyone gets bearish when you break a key technical level, like here. People are selling, panic. But then what happens? You get a big rally. And this rally went all the way back to a new all-time high.
Yep.
And we're just at that stage where we've had the break below a major level of support, had a big clear out of positions, everyone panic. And once that lightens up, what you can get is the false break of that low. And you can see this morning we're opening up, we're up 100 points. You know, we might have seen that panic selling done, and especially the tax loss selling sort of thing as well, that was really adding pressure to the downside. That if that's now taken off the market and it's been sold pretty hard, it's not going to take much for this to have a mean reversion move. So what I'm saying is, you know, back to that 20-week moving average, let's say, you know, that's another 500-600 points higher. So it's going to look like a good rally.
Yep.
Even if the long-term picture is of a market that does that and then does that,
yep.
You know, if you're looking at a long-term trend, that's sort of how it goes, isn't it? If we're looking at this now becoming a sort of long-term downtrend, that's sort of how it moves, right? So all I'm saying is that right now, for me as a trader, I'm looking at that saying the path of least resistance here is up, and I know very quickly if I'm wrong. So if the market turns back down, goes back through the low of the correction, watch out. You know, that is the clear signal, is if the selling returns, goes down through that low, I'm saying that really watch out what could happen. But just the setup now for me is, from a trader's perspective, I'm saying it's been a really big smashing. It's gone through a big key technical level. Tax loss selling is done. Panic. That's now stopped. Bonds are rallying. Path of least resistance for me is probably up. So I'm out there searching for the beaten up tax loss selling stocks, and just for a quick trade, you know.
Well, I was going to say, it certainly makes sense from a sentiment perspective as well. I think it was a couple of weeks ago in the Insider, I wrote about how everyone was on the same side of the boat. You had the sentiment, the CNN fear and greed indicator was down at 14, which is extreme fear. You had these, and the US does it so much better. They've got, you know, weekly sentiment indicators that have been around for decades, and they were at extreme lows. And we're talking about 2008, 2009 type level lows. So the sentiment 2 weeks ago seriously could not have been much worse.
Yeah.
So and from a trading perspective, sometimes it doesn't really matter what the headlines are. A lot of that is all in the price. And if you get these signals, which is what you're seeing now, you know, as a trader, you probably should be taking them. So I guess just to sum up, Muzz, what I'm hearing is we've got short-term buy signal in the market. We look like we could mean revert for, say, the next couple of weeks or the next couple of months, or however long it might be, depending on the pace and extent of the move. But overall, the longer-term trend is still in bear market mode, and we need to be careful and put your stop losses in and just watch out for a turn in the market.
Yeah. Basically, it's saying that the path of least resistance up, but if it does turn down through the low of the correction, you're out. You're not mucking around with it. But the risk reward for me is as a buyer in this market right now.
No worries. All right, mate. Well, I look forward to seeing what you do with the pivot trader and the microcap trader in the coming weeks. And we'll leave it there for today. And thanks for watching and listening. And I'll be back on Wednesday with another market update. Cheers, Muzz.
Cheers, mate.